Hey there, everyone. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from actually a beautifully overcast is the word, and wonderful Redmond, Washington. Thanks for joining me here every weekday after the close as we break down the market action using the power of technical analysis and behavioral finance. We're experiencing a bit with our kickoff time, aiming around 5 p.m. Eastern here for a week or two, and see how that feels in general. I'm trying to just figure out how to slot this show in amongst the other things that I'm asked to do on an average week, and hopefully this time works for all of you. We are live streaming the show on Facebook, LinkedIn, YouTube, and X, so we appreciate you wherever you're tuning in from. I can see questions that you put in on any of those platforms, so anywhere where you have an opportunity to drop a comment, please feel free to ask a question. And a little later in today's show, I will try to take a question or two before we wrap the live stream for the day. Anything we don't get to, we'll put it in the mailbag, and we do a mailbag episode. Probably we'll do one Friday because we won't do a live show because the half day for the equity markets, but should give us some good stuff to talk about. Things kind of back to normal here in Western Washington. We had the bomb cyclone last week. The stock charts office, where I spent a decent amount of time, even now, closed all last week because they just didn't have power. Got it back over the weekend. So thankfully, damage was minimal. It was just completely disruptive to the power grid. So thankfully, everyone's safe, at least that I'm close with, and doing okay here. Interesting day today. Obviously, the general playbook for a lighter holiday week is lighter volume and generally drifting a bit higher. The S&P did close above 6,000. That's pretty meaningful. So look at the chart of the S&P amongst others. We're also going to focus a little bit on, some of the charts actually showing some constructive developments. We're actually seeing some improvement in some areas of the market. Stocks that had pulled back kind of in the October, November period, and all of a sudden starting to bounce higher a little bit. I always hesitate, particularly with improvements in different indicators, to get too excited during a holiday week, because this is all often sort of a head fake kind of week, because things are generally drifting positive. I think the week to come, right, the week after Thanksgiving, we have a couple normal weeks between Thanksgiving and Christmas. That's when you can get maybe a little more proper read on what's going on. By the way, there are areas of the market that are still not doing well. Semiconductors obviously come to mind. We've got some earnings in that space this week to think about, but also inflation data, and that's what will be the discussion tomorrow. So we will do a show tomorrow just to recap sort of the post-inflation reaction, because we have the PCE number coming out at 10 a.m. Eastern time. With that in mind, let's get to our market recap and look at how the charts played out today. The major averages overall kind of higher. You can see the S&P finishing 0.6% to the upside, and that closes around 60.22. That's a close above 6,000. The Dow just slightly below 45,000, up about 0.3% from Monday's session. The NASDAQ composite pushing higher about 0.6%. Mid caps and small caps lagging today. So the S&P 600 small cap index down about 0.9%. The VIX continues to go lower, and if there's, again, kind of classic move within a holiday week, you usually have lower volatility because you don't usually expect big significant moves in a shortened holiday week. However, the main reason why we watch the VIX, I would say at this point, is because conditions are good. The S&P is making new highs. The trends overall are positive. My market trend model on all time frames is bullish, which means I'm always looking for signs that something's different. And the VIX spiking above 20 would be one of those things that would definitely be different, particularly when we've had a protracted advance, particularly when a lot of investors are sitting on a lot of paper gains. Most likely, if they start to take profits, start to unwind some of those successful positions, that's what can cause a waterfall decline that really starts to accelerate. And a spike in volatility is usually a great way to assume that that is actually starting to happen. That's why we look at the VIX for now, not seeing that at all. VIX is remaining fairly low, telling you low volatility, low uncertainty. Interest rates overall moving higher today. The 10-year yield moves slightly higher, finished today just above 4.3%. The 5-year point just below 4.2%. The long bond yield right around 4.5%. Dollar index, not much of a change, to be honest with you, from Monday's close. Commodities overall, kind of a choppy session. You can see that the DBC, which is a broad commodity ETF, ended up pretty much exactly where it closed on Monday, but that was after a much higher open. You can see the same thing with gold and silver prices, quite a bit of volatility. Gold actually finished slightly higher, about 0.2% up to the upside for the GLD. The SLV, a silver ETF, was up about 0.6%, but they spent much of the day kind of going above and below that zero line. Crude oil prices came off a little bit. Energy, we'll see in a moment when we get to the sectors. Looking at cryptocurrencies, we continue to see a pullback after Bitcoin tested 100,000 for the first time. That was over the weekend. We briefly touched that 100K mark and have come off since then. Bitcoin currently around $8,000 below that level, just around 92,000. That is down slightly from yesterday. Ether price is down about 2.4%. Right around 33, which is a nice number to revolve around. Most of the top 10 coins moving lower today. And again, I would say that generally speaking, I would say that is a reaction to that test of sort of the resistance level, right? The level, 100,000. I think at some point Bitcoin gets well above there, but for now it's serving as a pretty clear psychological resistance level. And now the longer we spend below there, turning out to be kind of a price resistance level as well. Looking at the 11 S&P sectors, you can see that 9 out of the 11 were in the green, and that's good. You can see that the top performing sector, though, probably one of the more defensive ones, utilities, the XLU was up 1.6%, followed by healthcare, which has been kind of the laggiest of the laggards in the last month or so. Healthcare probably the worst performer of the 11 in the last month, up about 0.5%. Technology number 3, and real estate tied for third as well, right around 0.5% higher. Only 2 of the 11 sectors were in the red. Materials down 0.8%. Energy down slightly, about 0.1% from yesterday. Looking quickly at the breadth, we can see that the breadth was more down than up, generally speaking. So this is just looking at the daily reading of advancers versus decliners, and you can see that in pretty much almost all of these, besides the S&P, decliners far outweighed advancers. And note the discrepancy or the disruption, discrepancy between large caps, the S&P 54% up, 46% down, versus mid caps 32% up, 67% down, even more exaggerated in the small cap space. So the smaller you went in the equity space, the worse things probably look here. It was a good day to be a big name in the S&P 500. With that in mind, let's look at the biggest of the big, the Magnificent Seven and Friends. Amazon moving higher by over 3%, 3.2% to the upside. Microsoft up over 2% as well. Meta having a decent update, up about 1.5%. On the downside, Tesla, the only one of these names down 0.1%. I had some questions from some of my market misbehavior premium members so far this week, particularly about Tesla. Obviously, very choppy chart. And I would say, for now, it's when you have a breakout and then it stalls out, it's all about whether we can hold that breakout level. And I would say still to be determined, right, with Tesla. Nvidia up about 0.2% as well. All right, let's go to the market carpet. As a reminder, a heat map visualization like this I find so valuable. And I feel like over my career, I've sort of made a side project of finding great visualizations that summarize a lot of data in a very digestible format, and using the power of data visualization to really bring in a lot of different data, but show it in a simple but powerful way. That's what drew me to the relative rotation graphs, the RRG, many years ago. And again, I'm so excited that platforms like Stock Charts feature that visualization now. I think that's a brilliant way of visualizing sector and asset rotation. Heat map visualizations like the market carpet on Stock Charts and a lot of other platforms have a heat map of sorts. I think just looking at the S&P 500 on different timeframes and doing it in the heat map format allows you to make some broader takeaways, right? It really helps you understand the equity landscape. So again, 3 things we look for. Number 1, overall impressions. What are the initial takeaways looking at the visualization? Number 2, the big dogs, the largest names that have the biggest weights. And number 3, the smaller opportunities, maybe some counter trend moves or some charts, some movements that disagree with the overall market activity. So, initial takeaways, I would say my general feel is this is kind of a choppy mixed day. Now, the major averages were a bit higher today, and that really tells you that it's the larger names that are really doing well, and that's outweighing the negative moves you see on some of the smaller boxes here. Within most of the 11 S&P sectors, you see some brighter red, and those are stocks that are down 3 to 5 even more percent. So within each of the 11 S&P sectors, almost all of them, you've got at least a name or two, and in some cases, quite a few rotating lower. And again, at this level, look at where you see more red than green, or which of the sectors look like they had the most trouble. I'm immediately drawn to consumer discretionary and maybe technology, right? But I mean, look at consumer discretionary. Look at all of these names like GM. Now, GM is a name, I mean, making a new 52-week high yesterday. Trump tariff announcement earlier today, that pretty much killed the mojo for GM, which has a lot of activities, a lot of exposure in Mexico. And if that's going to be, if there's going to be a 25% tariff that's introduced, that's going to hurt GM's business, and most likely, unfortunately, gets all of those painful tariff benefits get rolled over to you, to the consumer. So I would imagine cars are not going to get less expensive if we start taxing car parts coming in from outside the U.S. Having said that, things involved with cars kind of struggling as well. So you can see like a Borg Warner kind of struggling. Some home builders like Lennar down about 3%. SCP Pool, Mohawk, all having rough days as well. So just noticing within consumer discretionary in particular, quite a bit of red. Within technology, noticing some of these semiconductor names like Micron down 2.6%, Intel down 3.3%, AMD down 2.4%. So Nvidia, the biggest one by far, up about 2/3%, but the average semiconductor I feel like got dinged a bit today. And this is a group that's been struggling mightily in recent weeks and months. Second thing, we look at the big dogs, the biggest names. Amazon stands out to me, obviously, as the biggest gainer within that Magnificent Seven group, having a nice sort of upward move, 3.2% higher, not to new all-time highs just yet. That's around 215, but not too far above current levels. Another day or two like that would easily clear resistance. Also note Microsoft up another 2.2%. This is a stock that's really been sideways. I mean, it's really been a consolidating chart more than anything, and I think still more to prove to signal a nice upside resolution to that consolidation. But overall, a day like this certainly makes it seem a little more likely. Finally, looking for any other sort of outliers, any sort of different movements. Again, I'm also struck by some of the deterioration in stocks like WBD, Warner Brothers Discovery, Paramount, down about 4%. These are part of the entertainment groups that actually had been starting to recover quite a bit. Warner Brothers Discovery bottomed out around $6, $7, and then started to rotate higher and has gotten above $10 a share for the first time since Q1 of 2024. Today, kind of pulling back after that breakout, but again, some sort of counter trend moves relative to the general trend that we've been observing. Finally, within consumer staples, Target was an earnings miss, down another 3% today. Walgreens Boots got dinged pretty good over the last week, down another 3.6%. Constellation Brands, one of the beverage makers, not having a very good 2024, continuing to push to the downside, getting near to a new 52-week low. What's interesting about that, by the way, something like STZ making a new 52-week low. We talked about the Hindenburg Omen in the last week, and I did a separate YouTube video, particularly on the Hindenburg Omen, on Friday on my YouTube channel. And part of that signal, which would be a very bearish signal for stocks, would involve a healthy number of stocks making a new 52-week high and a healthy number of stocks making a new 52-week low. And that increase in both of those buckets is something that the creator of that indicator found as a very positive or very consistent pattern at major market tops. And so you need the constellations of the world making new 52-week lows. You need things like Paramount and others kind of reinitiating that downtrend if the Hindenburg Omen signal is going to be validated between now and kind of the third week in December, which is the window that we have available now. All right, let's continue on looking at the chart review. We'll start with the daily chart of the S&P 500 and go from there. As a reminder, I can see questions that you put anywhere on any of these platforms. I do see some questions coming in. I appreciate it so much. While you're putting in your favorite question, as a reminder, if you like this sort of work that we do on Chart This, if you want to learn more about how to analyze charts using technical and behavioral tools, if you think that there may be some room for improvement in your own investment process, which I bet there may be as we get closer and closer to year end, our free behavioral investing course could be a great way to sort of review and reflect and think about how you think about the markets. You can go to marketmisbehavior.com/free course to sign up for that, or just scan the beautiful coffee cup shaped QR code that you see on your screen. Love to see you take that course and be very interested to hear how that helps you think about the markets a little better. All right, the daily chart of the S&P 500, we do indeed have a new all-time closing high today, closing above 6,000. We did do that a couple weeks ago, but this is the highest close that we've seen, just above 60.21. So, Paul Montgomery, who wrote a newsletter called Universal Economics for over 50 years, he famously says, one of my favorite quotes on investing I've ever read, the most bullish thing the market can do is go up. We love to think so much and talk so much about what's going to make the market go higher. All right, but what could make it go to 7,000, et cetera, et cetera. He would always come back to the evidence of the markets. And he would say forget about all those things, about what would be the bullish catalyst. Like the most bullish thing that can happen is the prices go higher, right? That tells you all you need to know about the uptrend. And as a trend follower, I wholeheartedly agree with Montgomery's assessment there, and the value of trend following, the value of clearly defining the trend and tracking its persistence. So in this case, as long as we keep making higher highs, which we have done yet again today, as long as we keep making higher lows, as we did most recently with a swing low around 58.50 about a week ago, as long as that pattern continues, the trend is up. And what that means now that we've made a new high is at some point we will pull back. 58.50 is kind of that new line in the sand for me. And as long as we hold that on a pullback, as long as we hold an ascending 50-day moving average as we did at the end of October, beginning of November, then the primary uptrend is still very much in place. That's kind of my general assessment of the S&P. It's going to go up until it doesn't. The chart is innocent until proven guilty. Today, just following through on that uptrend. Now, one thing that has happened in the last couple of weeks is we noted in the month of October and into November some of the concerning breadth divergences. And what I mean is you have the market going higher, but the breadth conditions were actually going lower. And I'll point out on this chart, which is shows the cumulative advanced decline line for the New York Stock Exchange for large caps, mid caps, and small caps. We can see that the AD line for the S&P 500, the AD line for the New York Stock Exchange actually made a lower peak in early November, while the S&P was making higher peaks, right? So as the S&P is making higher highs, those were all making lower peaks. That has now been resolved. All four of these advanced decline lines have made new 52-week highs this week. And so as long as the advanced decliners keep going higher, I'm inclined to be pretty happy following this uptrend and assuming that it's going to persist, right? As a trend follower, I'm following this trend. The trend is up. The breadth data is starting to improve again. That tells me the conditions overall are pretty healthy. But it also reminds me when conditions are great, that's when you look for signs of potential deterioration. And that's why we're talking about the Hindenburg Omen as the S&P is making new all-time highs, because those early warning signs of a top often happen on the way up to the top, right? Leading into that peak. And there's a bunch of other things we could talk about if we do get an initial sell-off to kind of confirm or validate that a downtrend, an initial move, may lead to further declines. That's a separate part of the toolkit. But the Hindenburg Omen and other things like that, divergences, momentum divergences, are all more leading indicators. And that's where we're seeing some potential signs of topping patterns leading into the month of December. Here's the S&P 500, and the indicator at the bottom is called Chaikin Money Flow. This is an indicator that sort of looks at volume trends over time and looks for general periods of accumulation or distribution. And the way that is defined, according to Mark Chaikin with this particular indicator, periods of accumulation is where there's more volume on days that close higher. Distribution periods are where there's more volume on down days, or volume on the days where the price it finishes near the bottom end of the day's range. So in general, when the indicator is shaded green, that means we're in a period of accumulation. When it's shaded red, we're in a period of distribution. We had a bearish divergence in October, similar to the last three major tops for the S&P, where the price of the index had been going up. The trend in volume was actually sloping back downwards. Now, what's happened in the last week is the Chaikin Money Flow, which has been essentially dead neutral, saying basically we're at an equilibrium, right? Accumulation, distribution, kind of those forces are in tandem, in equilibrium. No real clear stronger or weaker side. As a result, it's been neutral. But in the last week, you're seeing that pop a little bit higher. That's something to watch. Now, again, I take this with a grain of salt in a shortened holiday week when the volumes are a little lighter and we tend to just drift higher just because. And it's so funny. I was taught when I was just learning about the markets a couple years ago. I remember someone basically saying, and this was a guy on the floor, said, "Yeah, all the traders are out, and so on the desks it's all the junior guys." And they painted this picture of like these really excited junior traders finally getting a seat at the big table and being able to trade actual stocks. And I'm sure that's not exactly what happens, but that's the picture that's always in my mind. These happy guys just, really thrilled to just trade a little bit and push the market up a little bit. And then it's back to normal next week when everyone kind of comes back and we sort of reinitiate a proper analysis of trend and volume. So for now, I'm not worried too much about that. I would say going into next week, that's when you really want to see if the volume continues to increase. If we see further accumulation when we come out of the Thanksgiving holiday going into the beginning of December. Now, volatility remains very low. Again, pretty common in this time of year, but you can see November of 2023, for example, we kind of went straight down from Halloween through right into Christmas, essentially. And that's pretty common this time of year because the market's generally drifting higher. We're sort of in that general uptrend phase, stronger months. And as a result, uncertainty is kind of at a lower period. So the VIX is coming down. I think this is an important chart to watch to look for spikes in volatility because that can often mean a potential end to the nice bullish uptrend we've experienced. And that's what we're seeing this week with the VIX kind of pushing down toward the 14 handle. Interest rates coming off of it so far this week. It actually gapped lower. This is the 10-year yield we're looking at. Gapped down around 4.25 yesterday. Here on Tuesday, we pushed up a little bit as bonds sold off slightly. So it's around 4.3% on the 10-year yield. I did want to point, though, the bottom here. This is showing you the shape of the yield curve using two different comparisons. The dark blue line is looking at the 3-month Treasury yield versus the 10-year Treasury yield. You can see that almost got to a normal shape, sort of eliminating that inversion that's been in place for over 2 years. It didn't follow through, though. Rates have remained, the yield curve remains slightly inverted using that particular comparison. 2s versus 10s is a more commonly used one. You see that at the bottom. It actually ended the day slightly inverted. It had been normalized early September. We're actually back down to a slightly inverted yield curve, a flat yield curve, I would say would be the best way to describe that. This is something to watch here, right? Because the yield curve has been inverted for so long. Sort of that normalization of the yield curve is kind of that, the way that the rates kind of come out of this period, and that you think about the Fed lowering the short end of the curve, things kind of normalize. But I think this idea that the Fed maybe not cutting as aggressively, which is the impression we've started to get, maybe that pushes the yield curve back to an inverted shape for a little bit longer. Something to be concerned about, particularly with financials, because that's where I tend to think of a fairly direct relationship between the steepness of the yield curve and the ability of like regional banks to make money, because that's pretty much how they do it, is using the shape of the yield curve. So a more normal yield curve is better for financials for sure. And that's been one of the top performing sectors here recently. All right, looking at some individual names, then I'll take a question or two before we wrap the show. Looking at Nvidia, as always, the Magnificent Seven stocks are top of mind. There's such a big weight in benchmarks, such a big weight in the sector ETFs. I think you really need to be familiar with what they're doing. I do want to note on the short term, on the tactical time frame, just looking at the far right side of that chart, in the month of November, we are range bound between around 130 on the lower end and 150 on the upper end. We reached 150 first week in November, and the last couple of weeks we've had a number of tests of that 150 level. We have not broken out still. And about a couple of days ago, I think that was Wednesday of last week, Thursday of last week, we did trade above 150 but closed back below it. And now we're back testing the 50-day moving average. So kind of a quick line in the sand for me would be around 132. That's the swing low from late October. We break below that. That would also mean we're below the 50-day moving average. Now, it's starting to look a lot kind of like this period back here. Look at how we broke out of resistance level. We stalled out around 100, really around 95 or so, had a double top, and then we pulled back to the most recent breakout level before we finally set the stage for the next move higher. We kind of did a similar thing here with a breakout above resistance. We've now sort of languished around 150. If we would break below that 50-day, I would be looking back down toward probably the 200-day moving average, which would kind of get us back into this range, sort of the range of the previous sort of breakout range, and see if that's where we find some further stability. But a break below 132, the RSI breaking 40, all of a sudden makes Nvidia look like a fairly challenged chart, and Nvidia has been one of the outliers that have actually held up quite well and still near new all-time highs, while a lot of semiconductor stocks have been selling off for quite some time now. You're seeing some utilities do well. I pointed out earlier, utilities, the top performing sector here today. You can see CEG, which had gapped down from around 290 to around 220 just about a week and a half ago, now regaining the 50-day moving average. A nice up day, up over 7%. That completes the closure of that gap that we experienced in early November. That was on Q3 earnings. We've now round tripped back to that breakdown level. Now I think you look for a retest of the previous highs, and getting above there, ideally on heavier volume, could be a bit of an all clear for a stock that had looked kind of challenged after missing earnings earlier in November. There's some stocks that are actually performing okay, and I would say Western Dig is one of those. This is a hard drive manufacturer in the technology sector. WDC is the ticker. Seagate STX is in the similar group. I kind of often look at the two of those together. I just want to point out that Western Digital came up on a screen making a new 3-month closing high that I was reviewing today. I'm noticing the RSI is pushing above 60. That's a pretty important development, I would say, for a breakout in price terms on improving momentum. That's what you want to kind of see. That's how a stock that has been sideways, choppy, more range bound, which is what Western Digital has been doing, actually breaking out on improving momentum is kind of a good sign for potential further gains. Now, the all-time highs here from June and July looming large. That's around $80 a share, about $7 above today's close. GM and some other auto-related names got dinged today. Again, when the Trump tariff sort of theme, I think it's going to be a tough one. I mean, the bad news for any sort of tariff on non-U.S. anything is going to end up getting passed down to consumers one way or another, right? I mean, either it's things are going to be more expensive, and companies aren't just going to give you the same goods and just eat the 25% loss because of the tariff. They're going to pass it on to you as a consumer, most likely in some way, either explicitly or implicitly, right? They're either obviously, or they will, wrap it into some fee or something, but they're going to want to make that money back. And so GM, out of the major automakers, you can see Ford down a bit, but GM down a lot more. When you look at the sort of initial assessment, GM has sort of the biggest exposure to Mexico, from my understanding. As a result, that big tariff on products from Mexico is going to hurt GM's business probably more than other automakers. So what's concerning about this chart, and I think what's frustrating, this is where sort of I hate to say Trump card. That's a horrible way to describe this, but it is an appropriate pun for what we're seeing here. This is one of those one-off things, right? I mean, as of yesterday, GM's making a new 52-week high. It's closing above $60 a share. It's making new highs. It's making higher lows. It's a really good chart. Now, it pulled back to the most recent swing low, so technically still an uptrend. But the fact that this is something that GM is going to have to be dealing with as early as a month out is a huge concern, I would say. So, watching that sort of the pullback, seeing if we're able to find some stability. Are we able to hold an ascending 50-day moving average? That would be an initial sort of thing I would be looking at there. All right, Align Technologies, ticker ALGN. This is a stock that's an interesting one. Not the classic chart I would share with you guys. I'm much more of a momentum investor, meaning I'm much more happy buying breakouts. I'd much rather buy the new highs list than the new lows list, generally speaking. However, when you have stocks that have been going down, when you have stocks that have a potential double bottom, which I think Align potentially has done with the August low and the late October low, right around that same level, right around 200, 205, we're bouncing up a little bit. And I would say that is where often stocks can become pretty compelling. I would probably, with this particular example, be way happier if we were able to clear resistance. The problem with this chart is we've had a couple rallies up to around 260, and that's where the stock has stalled out. That happened in September most recently. It also happened in July as well during this downtrend phase. A break above 260 would mean we're getting above the September high and the 200-day moving average. That's where I would be setting an alert, and I think clearing that level pretty constructive. But if you're more of a contrarian buying weakness, maybe there's enough on the chart to get you in and thinking about that as a potential retest of previous resistance. For me, I'd much rather follow the momentum if and when it can break above that previous resistance. AMGN's another one. This one got dinged today about 5%. Now it was down much further. It almost got down to a 61.8% retracement, which is why it came up on my radar. I was looking at a series of charts and I thought, ooh, this is actually getting really close to, a proven buy point, right? Sort of that level of support. Now enough buyers came in, it pushed it all the way up to 280, which is what I think could be a really interesting development. I wouldn't say this is any particular candle pattern. Can't really call that a hammer candle because the open to close range is way too wide. But I would say the fact that we saw buyers coming into AMGN through the course of the day is pretty encouraging. I'd much rather wait for some sort of higher low, some sort of broader illustration of an accumulation phase, but that's definitely something on my radar. Maybe bouncing off of an oversold condition recently. We'll see. All right. Couple of questions here to finish off the show. A couple questions on silver, actually, on X. Lulnick, you asked medium to long-term view of SLV. Let's go there, shall we? I actually think I have an intermarket analysis chart. I'm pretty sure I have silver on there, and if not, we can create it really quickly here. Gold and silver. I probably oversimplify and think of those two charts as very similar. And if you're looking at one, you're looking at both of them, and that's completely incorrect. And I've gotten slapped on the wrist virtually by a number of people that have reminded me that gold and silver are not, in fact, the same thing. I kind of group them together as precious metals, but they indeed are two very different things. And so recognizing those differences is probably a good idea, something I'll work on to improve my own process. Silver is an interesting one. Medium term to long term, right? If you think about the general trend in silver, it's been undeniably positive, right? 2024 has been a really good year for precious metal. It's been an exceptionally good year for gold, and I would say for silver as well. This is the SLV that we're looking at, but you could look at spot silver. There's the futures that we could look at here as well. The SLV is a good thing as any, and I would say that sort of medium term time frame is especially strong. What interests me about gold and silver here is it's almost setting up like what I would call a fat pitch chart. We're kind of out of baseball season, but to use that analogy, a fat pitch is something where the pitcher just hangs it right over the plate, and it's just a perfect setup, just a high percentage play. And, it's worth taking a swing at because chances are you can get the ball in play and do something good with it. And so this is one of those fat pitches, which is a long-term uptrend, short-term weakness, which means, you were buying at the lower end of some sort of channel, right? Think of a general long uptrend as having these little peaks and valleys, and the fat pitches, we're going in an uptrend, but we're pulling back in the short term, meaning you're buying at the lower end of an uptrend channel. That is a tried and true method of investing. A lot of institutions try to do a lot of quantitative models called alpha models that we would use as an institutional investor, are driven off that basic premise, which is looking for long-term strength and basically short-term weakness is a good opportunity to layer in. I like the setup that I see with silver and with gold as well. I do own gold. I don't own silver directly, but I do own the GLD. Not that I'm showing it here, but I would say in the short term, that's been the weakness. The medium term and long term, I would say for now, could be pretty compelling. Now, if something like silver gets much further, if we start undercutting that recent swing low, I would be a little more concerned, especially if we break the 200-day moving average. That's sort of a no questions asked, get out of the way kind of move. But for now, I'm kind of liking the setup. This is the kind of chart I would probably go to a daily chart and use the MACD or the PPO and look if you get some sort of buy signal in there. That can often be an interesting way to do it. All right, Bam Bam on YouTube. I love your name, by the way, Dave. Some of the hosts on IBD discuss their personal invested percentage. Would you consider sharing your invested percentage to help us see how you're personally reacting to the chart analysis you're seeing? Yeah, no, I've been on IBD podcasts. I've been on IBD Live a number of times. Those guys are awesome. And ladies, they're fantastic. Just really smart investors. They know the markets well. They know stocks well. I tend to avoid sharing too much besides disclosures, which I'm totally fine doing. I don't tend to talk a lot about my own personal investing. And I would say what differs is I know a lot of the IBD guys are trading individual stocks a lot, right? And they literally are building portfolios of the things that they're talking about. One of the things I learned a long time ago is I can do one of two things really well. At least this is how my brain works. I can either talk to you about the markets and review the charts and help you understand them, or I can focus my attention on managing my own portfolio and picking stocks and doing that. For me, that's a money management route that I never, I experimented with. I did not find a lot of joy and fulfillment doing it. So to be honest with you, I would disagree with people that say, yes, you can spend all your attention trading stocks and then also spend all your attention educating and teaching people and talking about. I just don't think that's a good match. So one of those is going to suffer. And I'm happy using more momentum-based automated models for my portfolios, which is what I do. And then I like talking about the markets in media like this, and sharing ideas with you. Having said that, I would say I generally rotate around a group of things. I have a group of ETFs that I analyze every month, and then I rotate to some of the stronger things. I would say at this point, in terms of full disclosure, I'm in large cap growth, which is still working just fine. I'm in gold. I think I'm in real estate, and those are the three general buckets that I'm in amongst a bunch of different ETFs that I could play. But on top of that, I actually have a smaller part of a portfolio that is more actively managed, that I think of as more the discretionary part of the portfolio. And I do own some individual names, but not many. Those are more long-term positions, things that I'm looking for. I'm looking for long-term growth. And so, having said that, I don't really know if answering that question is going to help a whole lot in terms of how I'm allocated, because I'm always fully invested, and I naturally rotate to things like bonds or real estate or gold if the charts are working, and if they're doing better than stocks, I'm going to be there. So, besides large cap growth, most other equity buckets don't look particularly strong to me based on my momentum analysis. So. Not really there. Final question, and then we'll wrap the show here. Bill Brewster asks, any idea what the win rate is on the Hindenburg index? Yeah, the Hindenburg Omen. No, and I don't. I've not tested that model, and I'm often asked about back testing. I as much as we think that back tests are a really good way of determining efficacy or effectiveness of different indicators, I have not found that to be the case. And that could be a subject of a whole other webcast we could do someday about the fragility or the inconclusive results that I think you can draw from back tests. Having said that, I think the problem that a lot of people have with the Hindenburg Omen is it gives a lot of false positives, right? So you get these signals all along the way, and it doesn't work particularly well. And that's why I would not ever run a Hindenburg Omen portfolio. And the moment I see it, I make aggressive trades. Because for me, it's one of those early warning systems that causes me to look for other signs of deterioration. I don't think it on its own is going to be a very good trading system. So, the hit rate, I couldn't tell you. I would say it over signals. It's one of those things that, has called, 20 of the last 10 corrections, that kind of thing. And you've had some initial false positives even in 2024, but waiting for that confirmation, which is the second appearance within a month, definitely improves the hit rate of it. And then again, for me, looking for signs of deterioration after, that's where you really qualify and validate something like the Hindenburg Omen. I'll continue to follow those signals for sure. I'll be sure to share them with you if and when I see that second confirmatory signal. Folks, that'll do it for today's show. Thanks so much for joining me here on a Tuesday just before Thanksgiving. We're going to do an adjusted schedule for the remainder of this week. We'll try to get a show out Wednesday and Friday, but don't hold me to that. We've got family in town here for Thanksgiving, and whatever you guys are doing with people that you love, I hope you find time to give thanks. And I want to thank you all for supporting me and my work. And chart this. For Market Misbehavior, I'm Dave Keller. Have a great night. And remember, it's always a good time